Imagine waking up to markets down 30%. Your phone lights up with headlines about emergency rate cuts. Banks are limiting withdrawals. Financial commentators are using words like systemic, contagion, and liquidity event. You refresh your brokerage account and the numbers look unreal. Retirement savings sliced in half, investments you thought were solid suddenly collapsing. It feels shocking, sudden, random, but history tells a different story. In 1929, in 2008, and in dozens of financial collapses around the world, the same sentence echoed afterward. The signs were there. The uncomfortable truth is that financial crises do not come out of nowhere. They follow a pattern, not just recessions, not just bubbles, true systemic breakdowns. And once you understand the sequence, you start to recognize the rhythm before the music stops. The tragedy is not that crises are unpredictable, it's that they're ignored while they're forming. In this video, I'll share the key signs that the financial meltdown is on the horizon and what you can do to safeguard yourself. This is what always happens before a financial crisis. To understand what always happens before a crisis, you need to understand what a crisis actually is and what it isn't. A bubble is when asset prices disconnect from reality. Tulips in the 1600s, dot-com stocks in 1999, meme stocks, certain cryptocurrencies, prices surge because buyers believe they can sell to someone else at a higher price. That's speculation. When the bubble pops, investors lose money. It hurts, but the system often survives. A recession is broader. It's an economic slowdown. GDP contracts, unemployment rises, spending declines. Recessions are painful, but they're part of the normal business cycle. Central banks lower rates. Governments stimulate demand. The economy adjusts. A financial crisis is different. A financial crisis is when the financial plumbing breaks. Banks fail, credit markets freeze, liquidity disappears, trust collapses. The difference between a bubble and a crisis is one word: debt. Speculation creates illusions. Debt turns illusions into systemic risk. Every major crisis begins with prices rising faster than the underlying reality. In the Roaring '20s, stocks were seen as a one-way ticket to wealth. In the mid-2000s, housing was considered untouchable. Real estate never falls nationwide. That phrase became gospel. In every era, there is a narrative explaining why traditional valuation metrics no longer apply. It always sounds reasonable at the time. Productivity has permanently increased. Technology changed the rules. Central banks have mastered the economy. Housing shortages make prices immune. The internet eliminates old constraints. Investing becomes cultural. It's no longer about fundamentals. It's about participation. When your neighbor, your barber, and your Uber driver are sharing hot stock tips, you're not at the beginning of a cycle. You're near the end. Valuation stops mattering. Earnings stop mattering. Risk stops mattering. The only thing that matters is price momentum. But speculation alone does not break the system. It sets the stage. Here's where fragility becomes danger. When people borrow heavily to buy assets that are already inflated, the structure becomes unstable. Leverage magnifies gains and magnifies losses. In 1929, investors bought stocks on margin. When prices fell, margin calls forced investors to sell into falling markets, accelerating the collapse. In 2008, homeowners were leveraged. Banks were leveraged. Investment firms were leveraged. Mortgage-backed securities were leveraged. When housing prices dipped, defaults spread. Those defaults hit lenders. Lenders tightened credit. Tightened credit slowed the economy. Debt creates dominoes. When asset prices fall and borrowers cannot repay, losses cascade through the system. The problem doesn't remain isolated. It spreads through balance sheets. And once enough balance sheets weaken, trust begins to evaporate. Financial systems don't run on money alone. They run on confidence. As long as participants believe that debts will be honored and liquidity will remain available, instability can be absorbed. But once that belief fractures, panic accelerates. In 1929, once selling began in earnest, buyers disappeared. In 2008, after Lehman Brothers collapsed, banks stopped trusting each other overnight. Interbank lending froze. Liquidity evaporated. Without liquidity, markets fall faster. Falling prices trigger forced selling. Forced selling pushes prices lower. Lower prices trigger more margin calls. The feedback loop forms. Euphoria builds slowly. Panic moves quickly. And by the time the average investor realizes something is wrong, the system is already in motion. The signals aren't hidden. They're just dismissed. Credit expanding far faster than incomes. Asset prices rising far beyond earnings growth. Widespread belief that risk has been engineered away. Before 2008, mortgage lending standards collapsed. Before 1929, margin borrowing exploded. Before nearly every sovereign crisis, government debt expanded unsustainably relative to GDP. Another signal is narrative confidence, when people believe downturns are impossible, when buy the dip becomes reflexive, fragility builds. Fear assets offer clues too. Gold and other defensive assets often surge when confidence drops, not necessarily because inflation spikes, but because anxiety does. Markets don't just price economic data, they price emotion. And when emotion shifts from greed to fear, repricing is violent. Why modern crises could move faster? Today, cycles move at digital speed. In 1929, panic spread by newspaper. In 2008, it spread by cable news. Today, it spreads through social media in seconds. Capital moves globally in milliseconds. Algorithms respond automatically. Speculative booms can inflate faster than ever before. Confidence can unwind just as quickly. We may not wait decades between systemic events. The timeline compresses. That doesn't mean catastrophe is imminent, but it means fragility can build quietly beneath strong headlines and record highs. When markets are calm, risk feels invisible. That's often when it's highest. Every crisis has a trigger: a rate hike, a bank failure, a geopolitical event, a corporate default, but the trigger is rarely the true cause. The true cause is accumulated fragility, excess leverage, overextended valuations, complacency. When the forest is dry, the spark doesn't need to be large. Crises are not black swans appearing from nowhere. They are structural imbalances finally exposed. You cannot perfectly time the next crisis, but you can structure your life to survive it. Diversification reduces concentration risk. Limiting personal leverage reduces fragility. Liquidity provides flexibility when credit freezes. Avoid chasing narratives. If something feels like a guaranteed path to wealth and everyone agrees, slow down. Risk is highest when it feels lowest. Financial literacy is your edge. When you understand cycles, you stop confusing rising prices with reduced risk. You stop assuming that central banks can permanently eliminate downturns. You prepare quietly while others celebrate loudly. Another financial crisis will happen at some point. That isn't pessimism. It's historical precedent. Financial systems are built on cycles of expansion and contraction. The question isn't whether a crisis will occur somewhere again. It's whether you'll recognize the pattern before you're inside it. Every crisis begins the same way: confidence, leverage, and a story explaining why risk no longer exists. And every time, when that story collapses, the damage spreads through debt. Speculation builds the illusion. Leverage loads the system with risk. Confidence snaps. Liquidity vanishes. Once you see that sequence, speculation, leverage, confidence break, you understand what always happens before a financial crisis. And once you understand it, you stop being surprised when the cycle repeats.